Welcome to On My Way to Wealth, the podcast where busy Gen Xers can learn financial tips as they navigate life on their way to wealth. And now, please join your host, Thomas Russo.
Hello, everyone. Welcome to another episode of On My Way to Wealth. My name is Louis, and I'm your host. Today, I have a very good friend of mine to let us know exactly everything you need to know before you start applying for a mortgage and also after you've applied for a mortgage. He's a veteran of the mortgage broker world. His name is Thomas Russo. He's a managing member of Coltrain Funding Group located in New York with over 25 years of experience in mortgages. His company has a stellar 5-star Google reputation for a very good reason. Tom is the man. Welcome, Tom.
Hey, what's up, Lou? How's it going?
It's going great, man. Thank you for taking time to be here.
Haven't seen you in a while. You look good.
It's been a minute. Yeah, man. Thank you, man. Before we get into all the mortgage stuff, I just want to, if you could tell the audience just a little bit about you. You know, I know you've been in the mortgage industry for over 25 years, but what made you decide to get into it? Where were you before?
Yeah, I mean, 25 years goes by quick, too. And I started
when did you start? When you were two?
I started out when I was 19 or 20, and I was doing it part-time, working at Beneficial Finance, for those of you guys that remember that finance company. And I was going to school half the day and then going back to the office for the other half. And for some reason, I loved it. I rushed out of school to right to work and making good money. And I'm like, hey, if I could do this full time, I'll make double the amount of money. And it sucked me in, and it just, from that point on, I stayed with Beneficial. I got into a management program, then went over to a large, right now they're Mr. Cooper. It used to be Nation Star behind it.
Oh, yeah.
Before that. So I worked with them and learned a little bit more about servicing the loans. And then 2005, me and my partner said, hey, you know what? I feel like we need to change it up a little bit. And, a lot of people were going with a mortgage broker then. And we opened our own company, in 2005, and we haven't looked back since. And it's great because there's such a huge difference between banker and broker that most people don't know. I mean, most people call their financial, somebody doing the mortgage broker, even though they could be working for a bank or, they just reference it as, oh, my broker. But there's such a big difference between a banker and broker. And, I'll give you a quick scenario.
Yeah, tell us about it.
A banker, you got one set of underwriting, one guideline, one set of underwriting, one rate sheet. So it's like a one-stop, hey, you either fit in that program or you don't. And let's face it, I mean, every customer is different. They all, and a lot of people like options now. So if I have a customer that, something is a little bit different where I know which bank to send it to, and the same thing with pricing. One day a bank is priced really well. The next day they're not. So why should that customer be penalized for that and stay in that program? A lot of times we just flip it over to another bank, to get that customer the best deal, the best pricing. So I felt like I want to be a broker. I want to help customers and get them the best deal because what's the best referral, right? Is just taking care of the customer instead of forcing them to take your product like a banker does. So,
yeah, that makes a lot of sense. So a banker who's a direct lender is playing by one set of rules.
That's it.
And you either fit in that program or you don't.
Yeah, and sometimes too, just for example, you might be a cop and you might be doing some security detail on the side and you provide the tax returns and the CPA is showing an actual loss on that, security money that they're earning. It hurts them. So if they accidentally showed them the tax returns, there's nothing, you can't just pull that out of the file. So that customer now gets denied because he maybe provided too much information to the underwriter. Where in my situation, if that's the case, I could say, hey, listen, we messed up. We shouldn't have provided that tax return to this bank. The next bank, we're not. And it's no problem, no extra cost to the customer, no extra additional time, really. It's a better program for the customer to have options.
Gotcha. Yeah. So you as a broker, you have relationships with direct lenders.
We're 16 lenders right now.
Oh, wow. Yeah, that's nice.
So we got options. It's like going to the diner, right? There's not just one set of, one item on the menu. There's plenty.
That makes a lot of sense. Now, I wanted to ask you about your transition from being a W-2 employee to opening your own company, right? How was that transition for you? Because then eventually, right, you ended up having to worry about paying rent for a location, employees, and so on, right?
Yeah, I mean, listen, it's always nerve wracking. I kind of did it at the time I was getting married and having kids all at once, so it's kind of a little overwhelming. But
Perfect timing.
I wish I would have done it, from the beginning. But maybe then it wouldn't have taught me, the other side and what the differences are. Because I was always trained, working for a bank. Oh, brokers are bad. Brokers are bad, and that's it. It was in my head that way. So I'm glad I actually got to see it and actually experience it. But it was nerve wracking. I mean, just paying rent, paying payroll tax, expenses. The paper's not free anymore. It's come from my pocket. It's
right.
Getting everybody computers. But I think that's the first couple of years of a business. Now that I'm close to 20 years past, it's got different challenges. But for the most part, I wouldn't have traded it for the world. I mean, when you're a W-2 employee, you're stuck with that. They got you. It's, hey, you better work. You better show up 9 to 5. With me, I have 3 children, and I haven't missed an event of their whole life. I mean, it's the flexibility of being self-employed. As you know, I mean, it's tremendous. I make my own hours. If I want, the more I put into it, the more I get out of it. But I wouldn't change it for the world, just for the flexibility. Flexibility is everything in this world to me.
Yeah, there's a lot to be said for that, man. Being present there for your kids, because that's really the memories that they'll always have.
I haven't missed a practice.
Yeah, that's amazing.
That's my choice, of course. But I couldn't have done that working for a bank, W-2, where I have to be in the office. So
yeah, no, that makes sense. And you create your own definition of success. To you, exactly. In addition to money, like being present for your kids.
Yeah, if I want to come back here at 10 o'clock at night, no problem. I'm going to grind it at 10 o'clock at night and do some paperwork, or talk to some people with marketing.
And I'm sure you do at times.
Yeah, I do. Yeah, this weekend, I'm sure I'll be back here at one point, and, whether it's creating something for my team next week, a challenge, or just calling customers myself. That's the one thing I'm a little bit different. I'm still in the business. So I'm not an owner. I have 15 people that work for me, but, I don't just sit back and kind of, I'm involved. I write my own deals. I have a lot of referral partners that I deal with personally. I'm on the phone with realtors. I'm on the phone with customers. That's the only way to me is I have to be in it. So that's how I get my knowledge. That's how I know what's happening in the street. I know what's going on in the industry because I'm involved. I don't just sit back and kind of write bills and paychecks,
Yeah, you're dealing with everything that your employees are dealing with as well.
Yeah, so when they come to me with a scenario, I kind of my knowledge, I know which way to go, which lender to choose, or which program to choose. What challenges that are going to come about, so we could address it from the beginning. So.
Okay, and as a broker, can you tell us about? Just for people that may not be familiar, like how do you get compensated? Do they have to pay you themselves? Does the lender that you place the loan with pay you, or a combination of the two?
Yeah, that's a great question. Brokers are scrutinized. In 2008, when everything fell apart, a lot of blame was put on brokers, and maybe rightfully so. But a lot of the guidelines and a lot of the strict Dodd-Frank rule that was placed out there was really put on brokers. So what happened was a lot of people left the industry and went to go work for a bank because they can make more money. So we're really scrutinized of what we can make on a transaction. So here's an example. An FHA file that comes in, the banker might offer 5.5 interest rate. We're going to offer 5.5 interest rate. The rate is going to be the same. But where it's different is I have a set compensation with that lender. They're going to pay my office 2.75. Okay. Any excess has to go to the consumer. So for example, that 5.5 interest rate might be paying 4 points that the consumer really doesn't know about, but it's paying 4 points to that bank. The bank keeps it all. For me, I make the 2.75, and then that 1.25 additional 1.25, that goes to the borrower as a credit. So I know that I could always beat the competition based on that. Now, that's called a lender paid compensation. And it's, at times we don't make as much as we used to, or, what we can, but it provides such value to the consumer when you can give them an extra, an average loan, it's $400,000. So that's like $4,500 in money that we're giving to that consumer. So we don't make as much, but we get a lot more referrals, because people, that's real money. That's real money that they see. Where that other bank, on the other bank, he's charging 5.5, and he's actually probably has an application processing fee. It could be over $5,000 difference. Same loan, same rate, same everything, the equal playing field, but they're just allowed to make more money on the transaction. So, it's a big difference. It's a big difference, real money to a consumer, especially if they're, struggling with closing costs. We can help them in that situation.
Yeah, that could be thousands of dollars right there. So, yeah, 1 point is just a percentage of the loan amount.
Yeah, 1 point is 1% of the loan amount. So if it's a $400,000, that's 1% is $4,000.
Right. So if you're giving a customer $4,000 back towards their closing costs, they can use that.
Credit toward their closing costs.
Yeah, that's amazing.
So, yeah. And on top of that, we don't have an application or a processing fee, which, it's probably about another $1,200, $1,300 savings.
Yeah,
the banker does. So that
could pay for something else, right?
It does. And it's you're not adding more time dealing with a broker. You're not adding, any additional paperwork. In fact, it's probably quicker. And the reason being is because the banker has to fund the loan on a warehouse line. They have the money, but they have to write a check and actually get it approved. Where broker, same thing, but we're using other people's credit lines and they want to use the bank's credit lines and they want to close it really quick. They want to move on to the next transaction. So you're not adding any additional time. In fact, the average savings last year from using a mortgage broker was $9,400.
Wow.
So it's just the same loan. It's just people being educated about using a mortgage broker. So
yeah, that's huge.
$9,400 is real money.
Yeah, that's a lot of money.
Yeah.
That's very significant. And I appreciate you breaking it down. So I wanted to talk about some more of the basics too, that people should be aware. Like,
sure.
How does a bank determine if someone qualifies for a loan? Like, what specifically do they look at aside from like credit and things like that?
Credit is always important. However, debt ratio, people hear that word debt ratio. They're like, what is that? Debt ratio, believe it or not, we still use gross income, which to some people doesn't make sense because if, that's not the real money that they're earning. The net dollars is everything.
Right, the take home.
So if you're making $60,000 a year, that's $5,000 a month. That's what we're going to put on the application. So $5,000 a month. Most banks are about 45% of that. So the debt ratio is 45%. So you take that $5,000, you times it by 45%. That's $22.50. I think I have it written down. $22.50. Yeah. So $22.50. Your bills, your new mortgage payment, your cars, they can't exceed that 45%. So if, say, the mortgage payment is going to be $2,000 and you have a car payment of $300, you're at $2,300 right there. If you only make $5,000 a month, that's about 46% debt ratio. You're not going to qualify. Now, there's some different scenarios where you can, but for the most part, that's how they calculate the debt ratio. So they're going off your gross income. That's the major, that right now it seems to be the hottest button. They want to make sure you can afford the mortgage. Rightfully so. Again, they want to make sure that you can afford that mortgage, so they're going to check all your income docs. So the ability to repay is important. Loan to value is another one. Loan to value is kind of basically, what percentage of the money that you have in the transaction and what the bank has in the transaction. So for example, if you put down 10%, you have 10, the bank has 90. So the loan to value is 90% because the bank has 90% of that, that mortgage, that amount to buy the house, where you have the other 10. That's probably a quicker way to understand how they calculate.
Yeah,
that.
It's like the opposite of your skin in the game versus the banks.
Correct.
So it sounds to me like a lot of people probably do this process backwards, where they start looking for homes first, and then they try to get pre-approved.
Yeah,
after they saw
it
something
used to be, but we're in a seller's market right now. So a seller's market, someone's not going to show you the house unless you're pre-approved. So yeah, you could go on Zillow, you can go on Redfin, you could go on these different websites or Realtor.com. But an actual realtor is not going to show you the house unless you have a pre-approval in hand. So it used to be where, people would go in the house and say they're not pre-approved, but nowadays you need a pre-approval first, so it's trending in that way.
Yeah. So tell us about that process. What does it entail to get pre-approved before you start looking at homes?
Yeah, it's the way we do it. Our team, I can speak for, is, we'll have somebody go online or we'll do it over the phone, right? Those teams, whatever's comfortable for the individual. We'll go over it, we'll run their credit, but we run as a soft inquiry. So it's not a hard inquiry on their credit report. So it doesn't hurt them, doesn't lower their score, doesn't, start people calling them and harassing them. So it's a soft inquiry. But with that data that comes over from the credit agency, we're able to, to see what they qualify for, see their credit scores. We'll ask them to upload a pay stub so we kind of get a good idea, because let's face it, some people say they make 80,000 and then when you get to see a pay stub, it's 50. So we really want to make sure that, because when we issue that pre-approval to the customer, that's our name on it. And that's 100%, that's everything. Because let's face it, that realtor who's looking at it and sees Coltrain Funding or sees Tom Russo, if they had a bad experience once before, they will not accept your offer, Lou. They'll go with somebody else's just because it's a different name on that pre-approval. So I really make sure that my team, myself, we do our due diligence ahead of time. We make sure that we can get that customer approved, that there's not going to be any hiccups. We address anything, from the beginning, and then we issue them that pre-approval. So that pre-approval now, they're able to go look at houses. Now, every house is different, right? One might be 500,000 with, 10,000 taxes. One might be 400 with 20,000 taxes. So, we back into the debt ratio and see what the most they could qualify for. But a lot of times, all my, team members, myself, we're accessible because they're going to see it on the weekend. They might call me and say, hey, can you run the numbers on this house? We just saw it. We really want to put an offer in. So the pre-approval, it's good because we've done our due diligence. However, if I could approve you for $1 million home. That doesn't mean you want to spend that much money, that's
it really
a great
comes
point. Down to what you're comfortable with.
And I'm glad you bring that up, because that's one of the things that I work with my clients is, look, you could qualify for more than you could afford, because
Correct.
the debt to income ratio is taken into account. Your gross income, like you said, is not your take home.
Yeah,
and it's also taken into account only the minimum payments of whatever shows up on your credit report.
Yeah.
They don't take into account your child care and your groceries.
Or your cell phone bill, your utilities. They don't take into,
Yeah. So it's very important that yes, you want to make sure you're pre-approved, but you also want to make sure that you could afford the home at the 100%. Same time. Yeah. 100%. That's a great point. Yeah. That's how a lot of people got in trouble.
Yeah.
Okay, I got approved. Yeah, I'm just going to go for it.
Yeah.
So that's
I'm glad when they call me and actually want to run numbers on a specific house. I encourage that. This way, you want them to feel comfortable and not surprised, because let's face it, sometimes a listing might show the taxes are only $6,000, but meanwhile they're really 10. But the realtor put $6,000 on there because the actual homeowner is a veteran, so he's getting a veteran discount. She doesn't do it, or he doesn't do his job right, and he puts $6,000 in taxes. So now, when you think you're buying a house with $6,000 in taxes, you're really not. It's $10,000. Just because that guy was a veteran, that's the only reason why it was $6,000. So you want to address all that ahead of time and really, do the right job for the customer.
Yeah, that's a big problem. Absolutely.
Yeah, it happens all the time.
So, we were talking about loan to value, right? So let's say if somebody's putting 10% down, I know that most lenders ideally would like 20% down or more on a primary residence. What happens if you don't put 20% down, if you have less, like 10%?
Honestly,
5%?
I encourage most people not to put 20% down anymore. And when I bought my house, my father was like, hey, you got to put 20, you got to put 20 down. You got to put, that's all I know. It was beating my head that I got to put 20% down. And I did. And then the next month, my wife is saying, hey, we should do a new kitchen. I'm like, I don't have any money. So here I am charging on a credit card, taking out a home equity line eventually. Now I got more bills and,
you so could just put less down and have them do it.
So 20% is not always the best answer. Most people nowadays, 5%, 10% is like the number that they put down. So what happens is when you don't put 20% down, you have mortgage insurance. Mortgage insurance, there's two types, right? On a conventional loan, it's called PMI. That's what people are accustomed to hear. PMI, oh, I don't want to pay PMI. PMI is expensive. PMI is based off your credit score. Okay, so if you have, I'm doing $1 million purchase right now, and they're only putting 10% down, Take a guess what their mortgage insurance is per month.
I'm going to say $275.
Nope, $120.
Oh my God, that's nothing.
So if you have a high credit score, especially you being a financial advisor, does it make sense to put 20% down where you can only put 10 and pay $120 a month? I'm sure you could probably get a better return on that money. So that's where I like to sit down with people and show them that PMI is not a bad thing. The good thing about PMI is it's not forever. That PMI could be removed once that property has enough equity in the house. So, for example, this person buying $1 million house, his PMI is $120 a month. In a year or so, if he feels the value has gone up and his loan to value is below 80%, he can call up his servicer and tell them, hey, I think my value's gone up. There's a sale across the street. There's a sale around the block. They'll do an appraisal. And if they deem that there is enough equity, that PMI comes off. So who's better than that?
You're not stuck with it.
Now the difference is with FHA, loans, right? FHA has what they call mortgage insurance. It's not based on the credit score. They don't discriminate. It's for everybody. So if you have a 500 credit score or an 800 credit score, you're paying the same amount of mortgage insurance. Now they've just lowered it in the news probably about a month ago, which is good. However, it's still the problem with FHA, and I don't want to say problem, but the downfall of FHA is the mortgage insurance stays on the loan, usually for life, until you refinance out of it or sell it. So it's not always the best program. But if you do have a mid-6 credit score, it might be the better program.
Gotcha. And you can put 3.5% down?
FHA is 3.5% down, which is still great. Conventional, you could do 3% with some loan affordable products they have out there. But FHA is always a lower rate. It has the mortgage insurance for life. But I don't force a customer into one specific loan. I don't get paid more if I put them into an FHA loan, like some bankers may. I will sit down and compare conventional FHA and see what's best for them. It might be a lower monthly payment on FHA. We'll go that route.
Yeah, no, that makes a lot of sense. And that's part of what I do with my clients too. Is like, even if you can put 20% down, it doesn't mean that you should. So we evaluate. Okay, if you put 10% down instead of 20, here's how much more you have to pay between PMI and the additional amount you're borrowing. And see if it makes sense to just keep your money, right? Whether it's to invest it,
especially if you got a good rate of return on their money, it doesn't make sense.
Yeah, that makes a lot of sense. Now, you mentioned the words conventional and FHA. Can you tell us a bit about what the differences are of those types of loans?
Yeah, so conventional loans are backed by Fannie Mae, Freddie Mac. FHA is backed by the government, through HUD, right? So that's really the difference, the main difference. A conventional loan is the ideal loan. That's where you have a good credit score, a good debt to income ratio. You qualify for that conventional loan once we run it through their systems. And FHA is, I don't want to say it's a bad loan, but it's for lower credit scores, higher debt to income ratios, a lot more flexibility than just a conventional. So, we used to run about 80% conventional, 20% FHA loans. It's starting to change a little bit. I think a lot more people are taking advantage of FHA. So it's probably 60-40 nowadays.
Okay. So these entities are basically, are they backing the loan? Like, let's say if a lender
Correct.
lends.
Yeah, most people don't even know. If you pulled up your mortgage statement, it doesn't say, it's owned by Fannie Mae or owned by Freddie Mac. Or it might say FHA, but it doesn't show the other two. But they're the ones that are backing it for the servicer. So your loan may be with Rocket Mortgage, but it's really backed by Fannie Mae or backed by the FHA. That's,
Gotcha. Rocket might just be servicing the loan at this point.
They're servicing. So you're making those check payments and the monthly payments to Rocket. Rocket then takes that money and mails it over to Fannie Mae, which that's behind the scenes you don't see.
Gotcha. So they're not sitting here waiting for 30 years for you to pay them back.
No, I don't know. Which could be a lot of money too. Don't let that scare people.
No, it's pretty fascinating though, because I know that a lot of these loans, since they're backed by Fannie or Freddie, they also could end up being monetized like into like a bond, like a mortgage bond. So a lot of people actually own mortgage bonds, right? In their 401ks or,
Yeah.
it's pretty fascinating.
Yeah, MBSs.
Yeah. Mortgage-backed securities. So I wanted to ask you also about, let's say if you wanted to buy a rental property, a lot of people are very interested in creating some sort of long-term approach to wealth. What are some of the requirements there in terms of down payment generally, more or less? Like, is it more down payment, higher, do you need a higher credit score? Are you going to pay more in interest as a result? How does that work?
Yeah, it's funny. We just had a presentation here yesterday with 20 realtors and probably 5 customers, but it was all about buying an investment home, in here. People want to know about that. Like, that's a big, big industry right now, especially with Airbnb and Verbo. People want to like, hey, this is, and you might even include that in retirement planning, right? I mean, that's people seem to like want to buy a rental house right now. So the problem is, from a financing aspect, they want 15% down for a normal single family house. The problem is the mortgage insurance is very expensive because they know you're renting it. So what I always tell people is 25% down. That's where you get a good price. You don't have the mortgage insurance, but 25% down seems to be for an investment house. And not everybody has that. They want something lower. So what I always encourage people to do, especially if they're renting, because we have a lot of customers that are renters or live at home and want to start buying, just like they want to start buying crypto. They want to buy rental houses. So what happens is I'll tell them, go out for an FHA loan, because FHA, you only need 3.5% down. So you can go buy a 2-family house, 3.5% down. You don't need the whole 25. You buy it for 3.5% down. You live in the first unit. The second unit is a rental, which helps, right? So, helps the mortgage payment in half sometimes. The guideline is that you have to stay there for a year. So now you stay there for a year, you go buy another house and you move into that house, you could rent that property out. So now in essence, you got a 2-family for only 3.5% down.
Yeah, that's amazing.
So if you buy $800,000 house, what is that? 16,000 that you're putting down. That's it. And now you're turning that into a rental home. And chances are, hey, in 30 years or 20 years, whatever you do, that's a paid off asset for $1 million. That's pretty great.
Yeah, that's a great hack.
House at 5% down. And, people keep, there's a certain word for it, but when they keep, renting it out or living in it, renting it out and keep, moving on to the next one. But that's what a lot of people do.
Gotcha.
There's another program too, which is very popular right now. It's a debt service program. It's called DSCR. And what that is, they just look at your credit score and they look at the rent roll. So if that property, and that's 20% down. So if that property is $2,500 and $2,500, that's $5,000 in rent. As long as your mortgage payment, the principal, interest, taxes, insurance is not over $5,000, you're good to go. That's it. They don't look for any other income documentation.
Oh, wow.
So
that's pretty cool.
Those loans, those are really good, popular right now, especially in other states. They want to own a home in Florida and rent it out, or Carolinas nowadays, or, Arizona is a big spot. So that's what they do. Debt service. It's called DSCR.
Okay. Yeah. I think I remember it was like debt service something ratio. I forgot what the C was for.
Yeah. Compare ratio. Debt service compare ratio.
Okay. That's amazing though. That's why I wanted to have you on here, because I get questions from clients all the time about real estate. And think about it, just the jewels you drop here. Somebody can buy a 2-family on an FHA loan, 3.5%. Because you're right. A lot of people that want to invest in real estate are actually renters themselves.
I guess maybe because those people have stayed in an Airbnb and paid $10,000 a week for someplace.
Yeah.
So they kind of feel like, hey, I need to get in this game.
Yeah. So I love your tip, because it's like you can get into houses, minimum money down, 3.5, 2-family, live in it for a year, move out. Now you have 2 units right there that you didn't need the 25% down for.
Yeah, and it's paying it. And a lot of times they're cash flow positive, right?
Yeah. And then you move on to the next one. And then, from a tax perspective as well, if you decided to sell it after the year, then you would just pay, if you have a profit, right? Long-term capital gain. So it also works, right? On a primary residence, if you live in it 2 out of the past 5 years, and then you sell it and you have a profit, you have up to $250,000 tax-free income as a single individual, and $500,000 as a couple, so that's
and
another
we should
way.
have had you come in yesterday because there were some tax questions, and I don't like to talk about tax stuff. Hey, talk to a CPA.
Yeah, no, it's smart.
Yeah, I don't. That's not my expertise.
No, listen, it's a team approach, man. Which is why
you gotta be an expert. You can't be a jack of all trades. You got to be an expert in your
in your field.
Profession.
And absolutely. So
have good people around you. That's for sure.
Yeah, I always recommend people you have to have a team, man. And encourage them to communicate. I know when I've sent you deals, like you said, you get very involved yourself. You keep me up to date, and we strategize together. Okay, we're gonna do this down payment and this much. Because you don't want to just be flying blind. If you have a CPA and you have a mortgage broker, make sure that one hand knows what the other one's doing, so that there are no surprises.
Yeah, I don't want no surprises. I want that customer happy at the end. That's the goal.
Yeah,
I don't want no buyer remorse.
Absolutely, man. Also, I wanted to talk to you about the mortgage loans themselves as far as the length. Most people automatically think 30-year mortgage because that's the one with the lowest payment, right? Now, depending on people's goals, I've actually had some clients where it made sense for them to have either 15-year or 20-year. Some people didn't even know that a 20-year existed. I actually did a podcast episode on that. So tell us a bit about just those differences, like the different types of lengths of
Yeah, listen, 90% of the loans on a purchase are 30-year mortgages, right? People want the lowest payment. So the longer you spread it out, the cheaper the payment. So a lot of people will go for the 30 there. Where the flex terms come about are more on the refinance. So somebody could be in the house for 5 years, and right now we're at a high rate environment. But if that drops, people don't want to go back to a 30 and lose that term. So we can. I've done 18-year loans, I've done 23-year loans, 27. We'll tailor it to that. Most of our lenders will take that nowadays. A different. It doesn't have to be just 15 or 20. It could be 19 or 20. So 21. Odd amounts. So you really want to sit down and say, hey, listen, what can you afford? Number one, the rate is always cheaper on the 15-year. I've even done a 10-year. But a 15-year term. The good thing about a 15-year term, the payment. The most frustrating thing is when you make a mortgage payment, and on a 30-year mortgage, most of it goes to principal. So it's like, hey, I'm paying $1,000, but $900 is going to a principal. I'm not knocking anything down.
So interest, right?
I'm sorry, to interest, yeah, where the principal is only going down $100. You flip-flop it on a 15-year, and it's all going to principal, and it's very little to interest. So it's a good feeling when you're making that payment. Hey, I'm actually bringing down my balance. So I'll show somebody the amortization on a 15-year or on a 25-year and a 30-year, and they make up their mind pretty quickly when they say, hey, I don't want to pay interest anymore. I want to knock the principal down.
Yeah, you want to start knocking them down. So that's a great point about refinancing, because I've had clients where they might be into a home, let's say 6 years into it on a 30-year mortgage, right? So they got 24 years left, but then the interest rates drop significantly, and now they can do a 20-year loan or lower
and still save money.
Right? Yeah. And so it's like, wow, that's best of both worlds. You're saving money and you're shortening the term that is going to take to pay off your house.
100%. Yeah, that's great. That's the perfect scenario.
Yeah, so you're not married to that loan. You can still strategize even after.
Now, most people, I think the latest stat was 5 years. People will refinance a loan every 5 years. So even today, interest rates are over 6% now. That's what they are. So, but you're not, even though you're signing for a 30-year term at 6.25%, that doesn't mean you can't refinance 6 months later. So I always tell people, find the house that you love, the one that the area you want to be in, the neighbor, if it's next to you and there's a one chance of a lifetime to live next to you, or the school district you're looking for, whatever it is, the proximity to the job. If you fall in love with that house, buy that house. It's still a good time to buy a house, and the interest rate might be 6.25%. Yeah, it's not 3% like it was in COVID. However, it's going to come down. You're not married to that loan for 30 years. So that's 6.25%. If I called you next year, which is an election year, so it's probably going to go down, right? Usually it does historically. But if it's 5.25%, you're going to refinance to 5.25%. It's what we usually do with our refinances. We'll take it to the same lender. So if you have, UWM is a big mortgage player. We'll go back to them, and in New York, the mortgage tax you paid, you don't have to pay it again if you go back to the same lender. The escrows, your taxes, your insurance that you have in an escrow account, they roll it over right to the new loan. The title insurance that you already paid, we get a reissue rate. So the closing costs are relatively cheaper, much cheaper than a purchase when you go to refinance. So normally they're about $6,000. What we'll do is we'll time out where you missed 2 payments on the mortgage. So if you refinance today, you're not paying May, you're not paying June, your first payment's July. So those 2 months probably saves you $6,000.
Yeah.
Your closing costs are $6,000. It's a wash. So it's not going to be, oh wow, I got to pay closing costs again. You always want to look at that. You want to make sure there's a benefit. To go to 6.25% down to 6% might not be worth it.
Right. Yeah, that makes a lot of sense. Do a break-even analysis, and a lot of people don't realize that the closing costs don't have to necessarily come out of pocket, so you can finance.
Yeah, they're financed on a refinance. They're financed 99% of the time.
Yeah. Now you mentioned that it was a seller's market, so basically that means that there's not as much inventory out there, right? And so there's more demand. So the sellers have.
I think every state has an inventory issue. If you're a seller right now, it's no better time to sell your house. I mean, you're going to get a premium for your house. You're going to have people, this weekend, I know today's Friday, so I have a list of, people that are going out. There'll be 20, 30 people at a house for an open house. And you know what? There'll probably be 10 offers and they're all going to be over asked. They're all going to be competing with each other. So the seller's in control. The seller will dictate these terms that you scratch your head. You're like, how are they selling this house? The customer's waiving their inspection of the property. If the house doesn't appraise, they're waiving that. It's crazy right now. I mean, if you're a seller, now's the time to sell. The only problem is, where do you go?
Right, because then if you have to buy something, then you got to hire it.
Hence, that's the reason why we have an inventory issue.
A lot of people just...
I'm in a situation where I think my interest rate's 2.5%.
Wow.
Now,
you don't want to let that go.
We're kind of busting at the seams off the house. The house is starting to get a little tight. Kids are getting older. They want more space. But financially, to sell and go buy a bigger house, I'm going to be taking my interest rate from 2.5 to 6.25. I don't know if I'm willing to do that right now.
Right.
And I think a lot of people are in that situation, and that's why we have such an inventory issue.
Yeah, that makes a lot of sense.
Yeah, where a buyer's market, you're competing with other buyers. It's a totally different game than a seller's market.
Yes, and in a buyer's market, then you have too much inventory, right? And then sellers have to become flexible and offer you.
Oh, they got to be flexible. They got to offer you incentives. You're really competing with other buyers, but you kind of dictate the terms more than the seller.
Gotcha. But in reality, I mean, I like what you're saying because I tell people sometimes, like you were saying, like if you find a home that you love, it's the right school district, everything's right. Yes, interest rates are right. But if you could still afford it, go for it because, we don't know what the future holds, obviously, but it goes in cycles, right? Rates are going to come down eventually. And then you can refinance.
100%, we have it's a lot of people are taking advantage of it. And, I don't want to get off topic too, but on a purchase, we have what they call like an easy start program. So it's starting to get very popular because now people are starting to understand it. So what will happen is the house will overappraise. A lot of these appraisals are coming in higher. So because the house overappraised, you have some options. You can do what they call seller's concession and include the closing cost into the loan where you don't have to come out of pocket. Or you could do this easy start program. It's really another word for like a 2-1 buy down. What will happen is, say your mortgage payment is supposed to be 6.25%, 5%, $5,000 a month. Okay. The first year of the program will be 3.25%. Will be 4.25%. Okay. The second year will be 5.25%, and then it goes to the 6.25%. So the whole point of this program is to get you in the house with the lower interest rate, knowing that you're going to refinance in 2 years. Now, the good thing is that money that's set aside to help subsidize those payments, it never goes away. Meaning that say 6 months you want to refinance because rates are down, they will take that money and either cut you a check for what's in that escrow account or apply it to your payoff balance. So it's a good way of getting in that. I have plenty of people taking advantage of it. So it's, hey, you know what? My payment's $1,000 cheaper for the first year, which everybody seems to think mortgage rates are going to go down. So they'll worry about next year and refinance. But listen, the worst case is you got your 6.25. It's not like it's going to be adjustable or keep going
up. You
up.
already knew ahead of time, but with the
your payment is 6.25. But this year you're going to pay 4.25. Next year you're going to pay 5.25. So people are taking advantage of that because again they know rates are going to come down.
Gotcha. And I know you had previously mentioned to me as well as non-QM loans and non-qualified mortgages. Can you tell us about those loans as well?
Yeah, so a non-QM loan, I kind of touched upon it before with the DSCR.
Oh,
That's a non-QM loan.
That's a type of non-QM loan. Okay.
Yeah, so a QM loan is really everything backed by Fannie Mae, Freddie Mac, the ability to repay. They're going to really scrutinize and make sure you got good credit, make sure this was their answer to the subprime crisis. They want to make sure that these are good loans that are going to perform, where some loans are exempt from it, which is a reverse mortgage where they don't check you don't have to show the ability to repay. And then there's non-QM. So non-QM could be deemed another word for subprime, but where I like to use it is for self-employed borrowers. Self-employed borrowers, a lot of times, they make $100,000, but after they come to you, you're like, hey, you can write off your car, your mileage, they take advantage of what's out there for write-offs. And now they end up paying tax on, say, $60,000. So they made the money. They made the money. It's just they're able to write off these things. On a qualified mortgage, I have to use $60,000. On a non-qualified mortgage, I can be a little creative. Maybe use their bank statements. Maybe use their profit and loss statement that you give me. I could use the proposed rent, like a DSCR. It's a little more flexible for income calculations on those loans. Now, the flip side, it comes with a higher interest rate, but at least I'm able to help those borrowers out.
Gotcha. Yeah, that's interesting because, going back to debt to income ratio, you gave the example of somebody makes $60,000, they're using that $5,000 gross.
Yeah.
But if a self-employed individual makes $60,000, but they write off 30, they only made 30 for lending purposes, right? And so same money, right? But just because one has
money, so there's different ways. I can use if they got a 1099, say they're an Uber driver, and they get a 1099 from Uber, I can use the actual 1099 before you even write off anything. So that helps. I could take their business bank statements and look at all their deposits. If they're averaging a high amount of deposits, I can take that deposit number with a small expense ratio and qualify them off that. So it really helps the self-employeds.
Yeah, no, that's amazing, man. And I think it just highlights further why you want to work with a mortgage broker because
correct. I got access to those programs, and there's always somebody, being a little more creative and coming up with a program. The non-QM stuff, you're probably not going to find at your local banks.
Right.
The Bank of America doesn't offer a Chase. They don't want to touch that stuff. And listen, there's a little risk there. However, it's a different time than 2008 because people actually, in 2008 they would say if you were a police officer, they would say, "Oh, you make 100,000, yeah," and they write 100,000 and write the loan. Now they're actually doing their due diligence. You can't qualify for a non-QM loan by making up something. It has to be substantial. It has to be, self-employed. We want to see your tax returns.
Right.
We want to see your
business
bank
statements.
Exactly. So it's good. It's really helped out. That's why I think we won't see as much delinquency even if we go into a recession because we did such a better job underwriting these loans.
Yeah, a lot more due diligence. Yeah, no, that makes a lot of sense. Yeah,
so that's good for the whole industry. That's good for everybody. Nobody wants to see somebody kicked out of the house, for a loan.
There's still room for it. I think if done properly, there could be great tools that people can use to get into those homes, and they're not stuck with them forever necessarily.
No, I've seen so many people get into a loan, and all of a sudden they're killing it. Self-employed, they're showing they can't write off too much anymore, so now they qualify for full documents, and we flip it over to a QM loan and refinance it.
Yeah, awesome, man. So before I let you go, tell us where can we find you? Anybody that's interested in talking with you and just whether it's a website, social media, wherever you live out there in the internet.
I live on Long Island. That doesn't mean that, that I only write loans on Long Island. I mean, we do a lot of business in New York, all of New York, New Jersey, Florida, Pennsylvania, South Carolina, North Carolina, more on the East Coast. That's most of my business there. Where I got people, snowbirding down in Florida or living up in New York. New Jersey. You can find me on the web. Our website is very interactive, Coltrain.com. You can apply on there. But I'll give you my cell phone. That's how open I am. Like that. I don't mind customers calling me. And even if it's a question, like, hey, this is the loan I got. Can you help me? Or can you take a look at it? That's how I am. That's how I encourage my team to be. So I'll give you my cell phone on here. You can put it on there, but it's 631-275-7379.
He wasn't kidding. He was not kidding.
Salesman there, but just call me. That's easy. I make it easy.
I love it, man. Before I let you go, Tom, what are some don'ts that people should be aware of? Like, let's say they went to you, they got pre-approved, they put an offer in the house. What are some of the things that they should or shouldn't do, like with their credit or anything else, before they close on that mortgage?
Just be mindful. You're going for a house. It's probably the largest purchase of your life. Don't go out and buy cars. Don't buy the furniture beforehand. Kind of like, run everything by your mortgage professional. Just say, hey, you think this is a good idea if I switch jobs? No, it's not a good time to switch jobs.
Not before you close on this mortgage.
Let's wait. Get the house, then you could switch your jobs. Same thing with a car. Oh, my car's coming up on lease. Okay, well, if it's coming up on lease, we're going to assume that you're buying another car anyway. But if you just want to go out and buy an extra car, a second car, no, let me look at the numbers, because it might take you from not qualifying anymore. And you really want to be careful of that. So those are some of the don'ts. The do's is, just coordinate everything with your mortgage broker. Talk to them. Talk to them and let them know what you're doing. Let's
beforehand.
Yeah. But even during too, like, hey, this is, is this a good idea? Is this not a good idea? That's what I would suggest. So.
Yeah, no, that makes sense. I feel the same way with my job as a financial advisor. Is like, I don't want to find things out after the fact, because that's what I'm here for. Like, call me if things come up, you have a question. Yeah, we're here to help you. So
exactly. I'm like, tell me everything. Tell me everything about your whole situation. I'm not the IRS. I'm not. I want to know. Number one, for me being a mortgage broker, I want to know what bank to send you to. It's not always about price. It's about just getting you done and making sure that we can get you qualified for. So I'm an open book. Be an open book with me.
Awesome. I love it, Tom. Thank you so much for being here. Real quick, if you were in an elevator with a stranger that doesn't know who you are and you'll never see them again, what is something that you've learned throughout your life that you would like to just share for them to take away?
Oh, that's a good question. I wasn't expecting that, Lo. Thanks. I would say, being honest. Right? I would say, hey, just, is that the question though? I mean, being honest with people, like I always pride myself on just being honest with somebody, being upfront with them. I would expect that, I want people to remember me by that, like, hey, this guy's a straight shooter. He's not going to BS me. He's not going to be, so just being honest. And it goes, I tell my kids that all the time, just be honest with me. I'll even if you got in trouble, just be honest and I'll solve the problem, but I can't solve it if you're not being honest with me. So yeah. Honesty is big in my eyes.
No, that makes a lot of sense. Yeah. And I think relationships are stronger for it,
Yeah, of course. Sometimes, people don't want to hear the truth, but it's the truth. So, I could sugarcoat all you want, but what good is that? You want to know the truth. Hey, listen, sometimes I got to break news to people and tell them their interest rate's 7%. I don't feel good, but I'm being honest with you.
Right.
Your score is 600. There's not much I can do, but I don't tell them, I don't dance around it. It is what it is. So.
You tell them up front, so they can make an informed choice. No, it makes sense. Yeah.
Hopefully that answered your question.
It does. Yeah, absolutely. No, I purposely wanted to catch you off guard in that one.
Good. I love it. I love it.
Well, thank you so much, Tom. I appreciate it. I'll put your links.
This was fun, man.
Are you on social media at all or mostly?
My company is all over. It's Coltrain.com.
Okay.
It's on Facebook, same thing, Coltrain. We're up there on Google and Facebook and Instagram. I have an individual that handles my marketing, and I think he does a pretty good job. So we're out there.
Gotcha. All right. I'll put the links on the show notes
definitely.
As well.
And anyone that calls you, customers, I'll take care of them, treat them like, they're the number one customer.
Much appreciated, man. Yeah. Thank you so much, Tom.
All right. Thanks, Lou. Take care. Have a great weekend. All right.
You too. Thank you for listening to On My Way to Wealth. If you have any questions, please send me an email at luis@onmywaytowealth.com. The information provided here is for information and education purposes only. The opinions expressed herein are solely those of myself, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by my firm or myself about other parties' information or accuracy or completeness. All information or ideas provided should be discussed in detail with a financial advisor, accountant, or legal counsel prior to implementation. Thank you.